Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. It is 2026, June 8th, and today, markets are doing that thing where everything important moves at once. Oil, bonds, AI stocks, Hong Kong tech, and India's rupee.
So basically, the market woke up, spilled coffee on the bond desk, kicked the tech sector, and then asked emerging market currencies to clean it up. Very normal. Very calm. Definitely not the kind of Monday that makes your brokerage app look like a haunted calculator.
Story 1. Bloomberg reports that bonds dropped as Israel-Iran strikes raised inflation fears. Oil prices and bond yields moved higher, while S&P 500 futures were up about 0.2% after a sell-off in artificial intelligence stocks paused. The big concern is simple. Higher oil can feed higher inflation.
Oil is like the hidden subscription fee for the entire economy. You think you are buying cereal, shipping, plane tickets, or plastic containers, and surprise, oil is standing behind the curtain saying, plus tax, plus delivery, plus emotional damage.
Exactly. The finance version is that bond investors demand higher yields when they fear inflation will stay hot. If inflation data this week shows a large consumer price surge, that adds pressure on the Federal Reserve to consider higher rates instead of cuts.
I slightly disagree with the panic button, though. One oil shock does not automatically mean every family should dump their investments and start hoarding canned beans. It means check your debt, your emergency fund, and whether your portfolio only works when money is cheap forever.
Fair pushback. Story 2. CNBC reports that the tech stock sell-off accelerated in Asia, with SoftBank dropping 6% as investors soured on AI-linked names. The regional weakness followed overnight losses in U.S. tech, led by a sell-off in Broadcom.
The AI trade is having its first awkward family dinner. Everyone loved the story when it was, robots will make us rich. Now investors are asking, cool, but when do profits arrive? And why did I pay gourmet steak prices for what might be microwave noodles?
That is the core. AI may still be a major productivity trend, but valuation matters. Imagine buying a wonderful house at triple the neighborhood price. The house can still be wonderful, and your investment can still be painful if expectations were unrealistic.
For normal investors, the takeaway is not anti-AI. It is anti-falling in love with a ticker. If your portfolio is basically chips, clouds, and vibes, maybe diversify before the market sends you a breakup text written by a very expensive chatbot.
Story 3 moves to Hong Kong. The Seng Tech Index added MiniMax Group and Knowledge Atlas Technology, also known as Zhipu, marking the first inclusion of pure-play AI companies in that benchmark. But the timing was rough. MiniMax fell 8.4%, while Zhipu gained 1.3%.
That is such a market move. Congratulations! You joined the fancy index club. Here is your velvet rope, your passive inflow potential, and also a minus 8.4% welcome basket. Finance is the only party where the cake sometimes says, sorry for your loss.
Index inclusion can matter because funds that track the benchmark may need exposure, creating potential passive inflows. But it does not cancel broader market pressure. The Hang Seng Index closed down 1.2% at 24,657.06, and the Hang Seng Tech Index lost 2.7%.
Now India enters the chat, holding a calculator and a bottle of antacid. The rupee opened the week weaker at 95.35 against the US dollar, hit by a stronger greenback, rising crude oil, and Middle East tension.
And the Reserve Bank of India held rates while raising its inflation forecast to 5.1%. The policy message is cautious. Supply-side price pressure may be temporary, but officials remain alert to global price shocks and monsoon uncertainty.
This is where I reverse my earlier calm a little. For emerging markets, oil plus dollar strength is a mean combo. It is like trying to diet while someone raises the price of groceries and your gym membership bills you in a stronger currency.
Today's practical checklist. Watch oil, watch bond yields, and watch whether AI weakness stays contained or spreads. For personal finance, avoid overconcentration, keep cash for near-term needs, and remember that rising rates can affect mortgages, loans, and equity valuations.
Translation: do not let your portfolio become a group project where oil, the Fed, and one AI stock do all the work badly. Like, subscribe, and tell us in the comments which risk worries you more this week: inflation, tech valuations, or currency pressure.